Hello everyone, I'm Jim DeGaetano, CEO of Diamond Wealth Advisors. I am really excited for all of you to be here today. Thank you for joining me. You know, history does not predict, and there are no facts about the future. President Truman once said, the only thing new in the world is the history you don't know. So today what we're going to do a short presentation on 50 years in history, defined as 1972 to 2022. This presentation is called 50 Years, 3 Bear Markets. The purpose is to learn a few lessons that history may have taught us. Not that we know anything about what the future holds, but we can get an idea of a few things when we look back at history. For those of you that are 50 or over that are watching this, you would have gone through 3 episodes in which the U.S. stock market dropped in half. Wild. Absolutely wild. The song that came on at the beginning of the presentation was actually the #1 song in the United States on January 10th, 1973. It was You're So Vain by Carly Simon. Ironically, the Merriam-Webster definition of vain is having or showing undue or excessive pride in one's appearance or marked by futility or ineffectualness. I find this actually quite fascinating because the #1 reason people are successful financially is their behavior. And we as humans let our emotions guide our behavior and our decisions many times. In the song, which I'm not going to sing, you don't want me to sing anyways, Carly Simon says in the refrain, I bet you think this song is about you. Don't you, don't you, don't you? Okay? So studies actually support the statement that we as humans are wired to make poor decisions. And self-emotional decision making is actually a recipe for less wealth. And we're here to help create wealth and preserve wealth, especially when we're planning for retirement. So I found this quite interesting. Let's take a look at the 3 great bear markets of the last half century. Most of you will remember these. The first one, 1973, 1974, was the oil crisis. The S&P dropped 48%. Next, March 2000 to October 2002, 49%. And then the most recent, the Great Financial Recession, October 2007 to March of 2009, the S&P 500 dropped 57%. The critical point here is these were very real crises. These were not thunderstorms. These were hurricanes, folks. These were hurricanes. These were not a correction. A correction is greater than a 10% drop. And the average since 1950 from the high of the S&P to the low in any given calendar year is about a 14% delta. And so if you think of a correction, it's like a patient being treated, getting some stitches, and then being sent on their way. But this, what we're talking about, a crash, is like a patient being admitted to the ICU. So that's why we want to spend some time here on these. Let's go a little bit deeper. 1973 in January to October 1974. We had the oil crisis, the oil embargo. We had inflation exploding at that time. And this actually was the largest decline since the Depression to date at that time. We were in a recession, unemployment reached 9%, and of course, that famous Watergate scandal occurred during that period. So we had a crescendo of crises, political, economic, financial, geopolitical. A lot was going on during this period. Let's look at the dot-com bubble and the implosion of it. This was probably the greatest stock market bubble of our time. When you remember how technology companies were soaring in the late 90s. But then the bubble burst, the NASDAQ dropped 80%. We were in a recession. The Enron scandal, as well as a variety of other accounting scandals, led us to not really trust what was going on in corporate America. At that time, I was graduating college and we were learning all about this. And these were real-time case studies that we were learning. And ethics classes became more important and a requirement across universities. In fact, if you actually have any interest in learning more about what was going on at that particular time, there's a really good book by Roger Lowenstein. It's called The Origins of the Crash, The Great Bubble and Its Undoing. He does a masterful job in authoring a history of why these things happened, how they happened, what happened in the aftermath. Very fascinating. And of course, September 11th, 2001, we all know what we were doing at that particular time in history. So all of this was occurring during this great bear market in which the US S&P 500, the US stock market, dropped 49%. Then we get to the Great Recession. October 2007 to March 2009, we had the subprime mortgage catastrophe, is the best word to use. This was a big one. This was our generation's 1929 to 1932. The plumbing in the system really dried up and shut down. There was a global financial crisis. It was the longest, deepest recession since the 30s, and unemployment peaked at 10%. It was a disaster. Again, the cry was, this time it's different. But was it? What is the question? And what is the answer to the question why stock prices go up? Because we had these three drops, and we are where we are right now, and we're using the S&P 500 as a gauge to measure performance up and down. And we are higher now than what we were during any of those three great bear markets. So this very, very clear visual has a point to it. And the point is very simple. Superior companies have increased their earnings. Superior companies have increased their earnings. So look at the index of the S&P 500 in 1972. It was $118. As we speak today, as I am recording this, it is a little over 5,100. Okay, but at the end of 2022 was 3,840. That represents a multiple of 32 times from where it was 50 years ago. But let's look at earnings. The index that we use for earnings was $6.17. In other words, the cumulative collective earnings of the S&P 500 companies and their value, but what are they producing in earnings from that value? And then you look and the earnings are now 219. That is a growth of 35 times. So you can see growth and the increase in value are followed because an increase because of earnings. Going a little deeper, why have earnings gone up so much? Well, two reasons: productivity and innovation. Now, I could say that the US population increased roughly 50% during that time, but it's the productivity. And Americans increased their productivity in real inflation-adjusted numbers 2.5 times during that period, as you can see right here. I mean, that's amazing. But how did they do it? And that's really where innovation comes in. And that is the largest factor by far when you look at periods of growth is innovation. We're in one right now with AI. So 9 of the 10 most valuable companies in the S&P in 2022 did not even exist 50 years ago. That's wild. But it's also why you don't just have a portfolio, buy some companies, set it and forget it. It's why people hire wealth managers like us to continue our screens, updating our screens, and making appropriate decisions based on what's going on. As concerned as everyone is about prices, which we just talked about, you saw the huge drops in history, but also what has happened over the last 50 years because of productivity and the innovation that spurs it. Sometimes we forget the role of dividends. This is really, really important. And sometimes when we are concerned about retirement, we think of the growth of our portfolio or the income coming from the portfolio. But in all reality, what we really should focus is the growth of the income in the portfolio. It's not growth or income, it's growth of income. And this is important because the cost of living, which we call inflation, goes up every year. And sometimes it grows up, and most recently, grew much faster than we really liked. I actually am reminded by my father growing up what things cost when he was a kid. So a little exercise, if we look at what things used to cost back in 1972, a gallon of milk, 52 cents. average income was $9,400 a year. The average new home was $23,500, and a new car on average was $3,450. Things go up. Why is this important? If you're planning for retirement and you say, I'm going to need maybe 5, 6, 7, 8, 10, whatever amount you need per month in cash coming in after taxes withheld to be able to cover your needs, wants, and or legacy, that number could double or triple by the end of your retirement. So we have to craft a plan, and a portfolio is part of that plan to make sure the growth of your income can occur. That's called a sustainable rising income for your retirement. So how do we measure this cost of living? We do so through something called the Consumer Price Index, or CPI. And that's just a basket of normal goods that you would purchase. So take a look here at this chart. I love visuals. They speak 1,000 words. The index of the CPI in 1972 was 43. At the end of 2022, 297. In other words, the cost of living multiplied 7 times. However, as you can see here, the cash dividend, may I repeat, the cash dividend of the S&P 500 increased over 21 times during that same period. So, if over the long term, you want to keep pace with the rising cost of living, what do you think does very well in doing so? Yes, being an owner of companies, and those companies pay dividends that continue to increase over time, well and above and outstripping the cost of living we call inflation. So one of the other questions that would just come up, I would think if I were you watching this, would say, all right, Jim, I get that. But what if I was retiring during one of those periods and we don't know when these bear markets are going to occur? So what if that happened right at the beginning of my retirement? How would that work? Well, so since the end of World War II, with dividends reinvested, what is the longest time to break even? That's kind of the question, right? Now, first of all, the first thing I would say if someone said to me, well, I don't have time when you're about to enter retirement, my first thought would be, what is your time frame of retirement? Is it 5 years or is it 2 or 3 decades? Because if it's 2 or 3 decades, in other words, you're planning for a long, happy, healthy, joyous, and free retirement, then we still have planning to do. It doesn't stop once you retire. But the answer to this is 5 years and 8 months. 5 years and 8 months. And that would have been August 2000 to April 2006. That's a long time. So if you retired in July of 2000, I'm just going to be honest, that stinks. But with a proper plan, and there are a variety of methods that we as advisors can use to help protect in the early years of retirement, but also allow you to have longer term growth, segmented strategies, bucketing strategies, dividend-only strategies, dynamic withdrawal strategies. There's all kinds of things we do. But this 5 years and 8 months, this came from Jeremy Siegel, who is one of the foremost scholars of the capital markets. He wrote the book, Stocks for the Long Run. He was a mentor to Warren Buffett, actually. One of the things that is very important to remember is that as stock prices decline, value goes up. So price and value move in opposite directions. And if you just think about this rationally, let's kind of go through it. Prices fall, things seem like they're getting worse. But what happens if you're buying a home? Let's say you don't own one already. You're just buying a home and prices have fallen. That's great. What if you happen to be going in the grocery store and there's a discount, 15 or 20% off? Well, I know a lot of people that will buy 2 or 3 or 5 of the same thing just because it's on discount, which means you spend more money overall. But per unit, you're spending less. But historically, lower prices have signaled better opportunities, better value in every aspect of our life. When gas prices go down, we have more money in our pocket for other things, just as an example. Except one. And that one exception happens to be the stock market. And that is the prices of superior companies. Those superior companies in the U.S. that I just saw that have multiplied 32 times in the last 50 years. That the cash dividends have increased 21 times. When those superior companies drop in value temporarily, mind you, for some reason, and there's a saying on Wall Street right here, the stock exchange is the only place where when they have a big sale, everyone runs out of the store. Now, I'm not saying all of you do. You've been educated quite well and understand, as we mentioned earlier, behavior is the reason people are successful. You want to buy low and sell high. If you're continuing to sell low and sell low and sell low, and you know you got to rebuy, but you wait until things have recovered, you are selling low and buying high. We do not want that for you. We want you to create wealth and preserve it. We do not want you to lose it. So where does this leave us? The moral of the story is really summed up in this quote. Charles Munger was a partner of Warren Buffett. Warren Buffett actually had a great quote that I loved, and that the U.S. stock market is a device for transferring wealth from the impatient to the patient. Transferring wealth from the impatient to the patient. I love that. But his partner, Charles Munger, was a little bit more direct. And Charles Munger, may he rest in peace, he passed away this year. He said, if you're going to be in this game for the long haul, the long pull, which is the way to do it, you better be able to handle a 50% decline without fussing too much about it. 50% decline, which is what we've talked about during these three bear markets. Mind you, it was over a 50-year period. But the point is that for assets that you don't plan on using for 6, 7, 8+ years, I know when I like to bucket out strategies for clients, we're not holding stocks for money we need in the next 2 or 3 years. But 8 years or a decade down the road, yes, because that will keep pace with the rising cost of living. And oh, by the way, that break even of 5 years and 6 months, which was the longest time over the last 50 years that it took to break even. If you're not holding stocks for 6 years plus for money that you need, you're in good shape. You are handling that fat tail that we say, that big risk of selling low. Because if you're not holding stocks for money you need in the next year or two, and you're holding short-term interest-bearing securities, fixed income securities, we're not focused on high returns at that point. What we're trying to do, and this is really what it comes down to, we're not trying to maximize returns. We're trying to minimize long-term regret. And we as advisors know there's a variety of ways to plan and construct that plan and portfolio for the distribution of those assets according to your needs, wants, and or legacy. So there are key takeaways from this presentation. The key takeaways I'm just going to read verbatim to you because they are important. Number one, the shares of even America's finest companies have experienced frequent declines in price. We just showed you that. 2, some of these declines driven by very real crises have been quite significant. Most definitely. 3, despite these setbacks, leading U.S. companies have continued to grow their earnings and dividends strongly over time. And they've done that through productivity and innovation. As long as we can continue to innovate, we can continue to be productive. Companies can grow their earnings and their stock prices rise. We as investors profit and benefit from that to allow us a higher standard of living. And 4, their shares have overcome even the deepest declines more rapidly than one might expect and gone on to new heights. That's really what it's about. Always remember, past performance is no guarantee of future results. My compliance team, of course, made me put this on here. But it is true, just like the saying of President Truman that we said earlier. But past performance is no guarantee of future results. And so when you look at the world, there's really 2 ways to look at the world. This time it's different, or this too shall pass. The choice is always ours. Let me say that again. The choice is always ours. And while these 3 bear markets that I went through with you today were different, they were. The story is not necessarily that, it's what happened afterwards. So I think We will at some point down the road have another recession while we're not planning right now and see that in the horizon here in 2024. At some point it will happen. At some point we'll have another bear market. The point is to understand what happens during these, to plan before them, and our perspective. This time it's different, the world will end. Or this time could be different for different actors and different reasons, but this too shall pass. I choose the latter. I recommend you do as well. Thank you for your time. For those of you that are clients watching, I greatly appreciate you. For those of you that are not, you deserve to have a serious, unhurried conversation about what's going on in your life. And we do not want to wait to do that. At least you should not want to wait to do that until the next crisis, whenever that may be. And if you'd like to have a conversation, please give Diamond Wealth Advisors a call, 717-462-6422. Thank you for your time. Have a great day.